Good afternoon, everybody. How's it hanging? Oh, man. I don't know about you guys, but I feel like these trading sessions have been like running a marathon every day. But it's been great. Loving this price action. Alright, we got Netflix out, but let's do our disclosure here before we talk any trading. I am an associated member of T3 Trading Group, which is an SEC registered broker-dealer and member of Intercepic. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Here's the updated position disclosure. Right as the Chief of Compliance walks in, he can come over if he wants to and see that every position that I'm in is being properly disclosed to everyone who may be on YouTube and anyone who may be in the virtual trading floor. So we keep compliance happy. It's like, never mind, I'm not even going to say what I was going to say because, no, Chief of Compliance is here. So let's move on with our, afternoon meeting. What's Netflix doing? That's what I want to see first. Netflix is down. Let's get a look at this after hours chart. Oof. They hit it, bounce it back a little bit. Now it's breaking back down here again. Revenue is a beat. EPS is a beat. Streaming paid net change is a beat. APAC, I'm not sure what that is. APAC streaming paid net change is a beat. Beat. All right, guidance. Third quarter EPS $5.10 versus $4.74. Solid beat. Q3 revenue guidance is a little bit of a miss. $9.73 billion versus estimates of $9.83 billion. We have a small miss on Q3 revenue. They see their year revenue growth more or less in line with the expectation. Maybe the range is slightly light. Operating margins a beat. I always like a good beat on those operating margin numbers. Free cash flow is a little bit light. They're expecting $6 billion versus $6.59 billion, and they see net ads lower versus a year ago. I don't know what the expectation on the net ads are. It's obviously always a really important number for Netflix. Yeah. So I'm just scrolling up a little bit. Second quarter streaming paid net change. That's a big beat. So looks like they beat on every single number except one important number. The revenue guidance. I feel like revenue guidance is oftentimes like the most important number that most companies report. With that said, they beat on every single number here except that revenue guidance number, and it's kind of a small miss. Probably seeing Q3 net ads lower versus a year ago isn't great, but it's hard to really judge that without having a better idea of expectations. So this is the earnings season that we're in, and Netflix is a little bit of a taste. I feel like Netflix isn't really one of the Mag 7 stocks. I know it is. It's a FANG name. But I feel like we haven't been lumping Netflix in the same way. But it is up pretty big into this report. It's up big from that last earnings report that it had. So I think that the thesis still applies. My thought process coming into earnings season with these Mag 7 numbers is that the expectations are too lofty. And not only are the expectations too lofty based on the average sell-side analyst, I think that the whisper numbers, if you want to call them that, are even higher. So I think that we're in an earnings season here where if you beat by a little bit, it's not going to be enough. If you come in line, they're probably going to punish you. And I'm talking about specifically with these Mag 7 stocks that are up so much. I actually think it's going to be very different for some of the other companies that you might see that are super beaten up, where they actually could probably rally on inline numbers. And that's always been a theme of earnings season for years, is what has the stock done as you come into the report. It's not, it's certainly not that if a stock is at 52-week highs coming into an earnings report that it can't go higher. It absolutely can. It's just that the expectations coming into that report are usually very high. So, you know, coming with an inline number is not going to be good enough, and even sometimes a small beat is not going to be good enough. So it's going to be really interesting to see, like when we're looking at Taiwan Semiconductors this morning, which I think was actually an important one, and Netflix here this afternoon, how they trade these names on okay numbers. This Netflix report looks okay. Revenue beat last quarter, EPS beat last quarter, EPS guidance is a beat, the streaming paid net changes are a nice beat, and I got a miss by, you know, 0.1 billion on third quarter revenue, and that's enough to trade the stock down. That's kind of the theme that I'm expecting for this earnings season for these stocks, and it's part of why I think that the Qs have topped out. Maybe not for the full year, but I think possibly for some several months here. I wouldn't be surprised unless we have really, really stellar earnings reports from some of these Mag 7 stocks. I kind of think that they're topped out. So yeah, we'll keep an eye on Netflix. Report doesn't seem too bad. It's not destroyed on it by any means, but it is trading down about 20 bucks or so from where it closed today. So let's hop into the meat of our afternoon meeting. The S&P closed down 0.7%, the NASDAQ closed down 0.4%, and the IWM closed down 1.7%. So the IWM underperforming today as it further corrects the upside extension, which I think is exactly what we're looking for. Let's take a look at the daily charts. So SPYs here breaking lower. SPYs have lost some high-level support, that 556.50, which we kind of closed near yesterday. We lost today. So we got a deeper retracement to the 21 EMA. We overshot that 21 EMA even by a little bit today. There's a major support level at pretty much at 550, which held. Low of the day today is 550 spot 43. So we did hold that major support level at 550, which kind of coincides with the lower band of this equilibrium zone. So this is the spot, honestly, with the S&P that you start to not want to see it lose. Trying to remember off the top of my head what Pat's note said on what the CTA trigger level was. Let's see if I still have Pat's note available. I think this is the one from today, right? No, that's yesterday. 517. Do I still have today's, or did I close it out? Oh, here it is. 518. Yeah, here. That CTA sell trigger threshold number, the shorter term threshold number is 54.53. That's pretty much where we closed, right? We closed, I think, just above that. If anyone can give me a quote, I think we closed at like 54.45. Sorry, 50. These numbers are too big. I can't say them right. Never mind. We closed 100 points above it still. I think that we closed at like 55.45, and the CTA threshold is 54.53. So for the S&P, it looks like we're still 100 points away from that CTA trigger actually occurring. So we haven't even gotten into the point of a sell-off here where that feedback cycle of selling can actually really trigger, where selling becomes more selling. So I think that unless we really start to see those numbers breached, for the moment, the trend is your friend, and you want to assume that this trend is going to stay intact. If that trend is going to stay intact, the bull should really attempt to hold this 550 level. They held it today. The last major pivot low on the daily chart for the S&P is 545.50. So we're, sorry, 542.50. I can't say numbers today. 542.50. So we're still 10.5 bucks away in the SPYs from breaking the last major pivot low in the S&P. We broke a minor one today with this 555.83. We lost that, but the last major pivot low is still intact. So for the moment, our uptrend in the S&P is still intact. We haven't triggered the CTA levels that I think can really accelerate a feedback cycle of selling, but it is notable that this VIX picked up. The VIX picked up a little bit. Where did the VIX close today? Like 16 bucks or so. I think the VIX closed about $16, maybe just under $16. So the one thing that we said can increase correlations again is a VIX spike. Oh, thanks, Pat. For some reason, my VTF wasn't scrolling down. I'm just seeing, thanks Bill, thanks Pat, just seeing your numbers. So what was I just talking about? Yeah, the VIX. So we got a little bit of a VIX spike to about $16. I think that a VIX spike is what is necessary for correlations to increase, whether that's happening on the upside or the downside. So we did see a little bit of that these last couple of days, where we're seeing some more selling across the board. But overall, you know, the S&P here was down, I think, a little over 1% yesterday. It's down 0.7% today. That's become a big sell-off in the context of things. You know, 2% in 2 days, but really that's still relatively insulated. So, you know, we're still holding in for now. The trend is still holding in. We haven't triggered the CTA levels that can lead to selling being more selling, but we did get a little bit of a VIX spike, which can increase those correlations a little bit from that, you know, dispersion trade that we've been looking at. So that's where the S&P is. We'll see if they can hold that 550 tomorrow, which then, you know, tomorrow would be technically a day 3. So on a day 3, if we could actually break 550, break today's low tomorrow, I don't dislike the idea of actually looking for an RDR, if that RDR can set up for the S&P. So that's the SPYs. Let's see what our Qs look like. Let's see what our IWM looks like. All right, so Qs really extended to the downside. At the close yesterday, they were hitting that $10 worth of extension to the downside, but that's tricky because it's only a day 1. Today is actually a day 2. The market was nice enough to gift us with a gap up, which was shortable. I'll talk about that more in a minute. Someone emailed me a question asking if I could speak more about the Qs and why I shorted them this morning. So I'll circle back to that. But we had a nice gap up in the Qs. So the Qs are only down 0.36%, but it's actually a pretty wide-ranging bar, just because we had a decent gap up this morning. So, you know, we gapped up from a close on lows yesterday at just under 482. We gapped up like $3 or so over that, almost $4, just to fill that gap, create a lower high, and then break down further. So Q's only down 0.4%, but that's in the context of kind of extreme extension. ADMA right now is at 489. We closed at 480, but the low of the day today is 476.27. So at lows today, we were, what, $12, $13 extended. So we hit some pretty significant downside extension down there, with it being a day 2. So this is another one. I think for the S&P and the Qs, if tomorrow, it's an if-then statement, if they break today's low tomorrow, you might be able to buy it back up for that RDR trade, just for a retracement higher to satisfy some of the extension on a day 3, because our trends still are intact. You know, the Qs here are definitely what are leading us lower. I think we're all aware of that. We've discussed the reasons why, but even the Qs haven't really breached their major last pivot lows. You have a little pivot here from the beginning of July at 476.25, which is exactly what we held today, by the way. And then we've got, I think, a very major pivot at 473 spot 82 to pay attention to for the downside of the Qs. So Qs today, $10 plus extended to the downside. The IWM, on the other hand, which also traded down and led us lower, the IWM is down 1.8% today, is still satisfying the upside extension from that insane 4.5-day move that we had. I fully liquidated my IWM short today into 418. It got to my price correction trigger. It did exactly what I wanted it to do. It, you know, took away a little bit from some of my P&L on all my long positions when I started shorting it on the 16th. I closed with negative P&L on the IWM that day, but traded it very rapidly both yesterday and today, added all the way up, added above yesterday's high, and caught the entire price correction move down to 218, which is exactly what I was looking for. Liquidated the IWM, actually then flipped long below 218, which I said is maybe a little bit early. You know, the ADMA is still all the way down at 215. It's not impossible for us to correct to 216 or even 214 and actually still have the IWM then pivot back up and be healthy. I've been of the inclination, just with this rotation trade, that we were going to get a little bit more of a time correction than a price correction, which is why 218 was kind of the target there. And then again, I even flipped long as what turned into just a day trade in the afternoon today that worked out really well. with the thought process still that, you know, that IWM could correct a little bit further, because I think that the Qs actually probably need to bounce a little bit. Maybe they break today's low tomorrow and then bounce, but I think that the Qs actually, it's such a weird market dynamic where I need the Qs to correct because they're downside extended at the same time as I need the IWM to correct because of how upside extended it is. But the Russell now has pretty much done that. So I don't, and the ADMA will catch up further tomorrow. So I think that for the most part our IWM correction is done, and we should begin to look for a pivot. Which isn't to say that we can't correct further, it's just so that the meat of the correction is done and we should begin to look for a pivot. This is another one. I actually think for all three indexes, and we'll see if the correlations stay together or if there's a winner and therefore there has to be a loser like most of this year has been. I like the idea potentially, and I prefer to assess this tomorrow and prefer to assess it in real time. I like the idea of buying all three of these indexes back through today's low tomorrow if any of them can trade below today's low tomorrow. The IWM, you're doing that to potentially create a higher low for continuation in this move. The Qs and the SPYs, you're doing that as like an RDR as you come into a day 3. So I say that kind of big picture, but as far as the execution goes, we definitely want to see where we're trading tomorrow, what's acting relatively strong and what's acting relatively weak, or if they're actually all trading together, which all the indexes trading together has been a less likely situation, as we have also described. Trying to figure out if I have anything else to talk about the big picture of the market. I think that covers it. I mentioned that I got a question through email. Someone asked me via email if I could, in the afternoon meeting today, talk about how I traded the Qs. The trader who emailed me, I think, was a little bit surprised that I shorted the Qs when they were downside extended. You know, traders who have been with me for a while, who follow me for a while, know that when it comes to my index trading, I tend to not do it that way, because a lot of the times when I'm trading the indexes, I'm always trading them as trades, like I described when I did the podcast with David Prince and Scott Revler. I'm always taking those trades as trades, but they act as a hedge for me at the same time. That's what I did with this IWM. I've got stock on longer time frames for IWM correlated names. The IWM goes insane like this. It's a day 4, it's a day 5, it's super extended. I don't want to fully liquidate the longs that I have in these IWM related stocks. At the same time, I need to recognize that I'm probably going to endure a little bit of pain as those names pull back with the IWM because of how extended it is. So instead of just liquidating those longs, I'd rather come in and take a IWM short trade. So you see me do that a lot. When these indexes get very extended away from the ADMA, when they hit extreme extension on the upside or the downside, you see me coming on the other side a lot. And honestly, it's been an incredibly consistent trade for me the way that I've done it. I'm pretty sure that I still have a 100% win rate in that QQQ $10 extension trade going back to like some point in 2022. I don't even remember the starting point. So that's a pretty impressive win rate, honestly. It's worked extremely, extremely well. And this time I did it in the IWM, not the Qs, because the IWM was what got extended. But guess what? The 100% win rate on that trade still exists because I closed out the IWM today profitably after enduring some initial pain in the beginning portion of that trade. So that trade continues to just work really, really well. And, you know, I'll hop into talking about how I traded the Qs because that's where the question came from. I got to give myself a pat on the back. Anybody who's been trading with me knows me well enough to know that I am open enough with my trading where I really beat myself up when I do the wrong things, and I always admit and talk about it when I do the wrong things. But I'm also not afraid to give myself a pat on the back when I trade very well. And to give myself a pat on the back, I feel like, and I almost don't even want to say this because I'm worried about messing up my own psychology. I feel like I'm trading these indexes right now better than I've almost ever traded them in my life. I'm on both sides of the trade. I was doing things today in the Qs that I very rarely do. I was short the Qs, caught a really big move, flipped long for a scalp, sold the entire scalp, reinitiated the short position, caught the entire short position, hit a target on that short position, exited that short position, went long again for another scalp, made money on the scalp, and then stopped trading the Qs on the day. One thing that I traditionally was not very good at with my own trading, and I will say, even though I did it really well today, I'm probably still not very good at it, is actually being able to be on both sides of the same name like that. Usually just the way my thought process and head works is that I'll have a thesis and an expectation for a trade, and I am involved as the technicals are confirming the thesis for that move, and not being kind of cute and saying, oh, I can actually flip long here and make some money on the long side and then go back short. Traditionally, I would say I'm not a good enough of a trader to actually do that, but I was able to do it very well today, and with both the IWM and the NASDAQ. So, popping into how I traded the NASDAQ, and to answer Dave's question, Dave was the one who emailed me. So first of all, I'm doing it with the T-Triple-Q, not the Qs. And we need to take a big step back because this starts with a bigger picture thesis. And I've explained that bigger picture thesis as we come into the August trading period, or possibly even the post-July OPEX, which is tomorrow. So starting for Monday, where there's a potential, to steal a line from Jem Carson, window of weakness after OPEX, just because 2/3 of the gamma rolls off, so your distribution of outcomes can actually increase for the market. I've got a bigger picture thesis that these Qs have topped out. And again, I know this flies in the face of what I always say. I always say don't pick tops and bottoms in the market. And you know what? I'm not picking a top. I'm presenting a thesis that represents a pullback in the market, or that highs are in for a period of time. I'm not saying that this is going to be the all-time high. As a matter of fact, I assume that at a certain point we'll get above this high. But I think that we potentially have a short-term peak that has not yet been confirmed by a reversal pattern. We do not have a reversal pattern down here. The Qs are not in a downtrend. The Qs, if anything, are still either in an uptrend, or you could maybe make an argument that they have exited their uptrend and they've gone into just a trendless situation, which is more neutral. Which reminds me, it's another thing that we could do. I'm a little bit scatterbrained right now. Another thing we could do is we could play our bullish, bearish, neutral game to reassess where the market is. It's one of my favorite, step back things to do to get a bigger picture idea of how we should be positioning ourselves in the market. But one thing at a time. I discussed what my expectations are. I even just did it with Netflix on earnings for the Mag 7. I discussed, I think this morning and possibly yesterday afternoon, about how August, and I think this comes from the Rubner note at Goldman, tends to be a period of time for outflows for the market to begin with. That especially becomes true in an election cycle. So if history is any guide, and history rhymes, doesn't repeat, but take a half step back on my half step back, I used to really not believe in seasonality at all, because I would always say, hey, every situation is unique, and I don't actually want you to tell me that the first 2 weeks of July are seasonably very bullish, because I don't want to have in my head a bias that we should go up in the beginning of July, because just because something has happened in the past does not mean that it has to happen in the future. I still, at least to some degree, believe that what has happened in the past does not have to happen in the future, and the market is always a unique situation. History doesn't repeat, but it does rhyme. What has really changed my thought process was learning over the course of the last couple of years that why we get that seasonality actually has to do with like almost a forced flow of funds. Why is the first 2 weeks of July typically the strongest 2 weeks of the year? Is because when you come into the beginning of the second half, especially I think in a market that's already up on the year, there are forced new flows that basically have to come into the market that create that strength. August, traditionally, seasonally, is the opposite. Money flows out of the indexes in August, which doesn't even necessarily mean that the market has to go down, but what that does mean to me is if money flows out in August, which will most likely happen, it's what Goldman's modeling for, and that's especially true when people want to hedge themselves into an election cycle. This also tends to be what we see into every election period. I've mentioned every presidential election I think I've ever seen over the course of my career has started with selling into the election, followed by the market being bought up after the election. And guess what? It doesn't matter who wins the election. I mean, it does, but it doesn't from a market's perspective, at least based on my history of my career. Every single election, no matter whether the Democrat wins or the Republican wins, they sell it off into the election, and then literally like the next day after the election, the market rips. It happened last presidential election, just as an example, when Joe Biden versus Trump, the market sold off heavy into November. The election was over. That next day after the election, when Biden was announced as the president, the market ripped. That happens all the time. So now we need to understand how the NASDAQ and the S&P are structured. They are market cap weighted indexes. So yeah, the market abhors uncertainty, right? So once the uncertainty is out of the way, then you can rally. They're market cap weighted indexes, and the Mag 7 has led the entire market higher. Over the course of this year, the Mag 7 names have become an increasingly larger and larger part of the S&P and the NASDAQ. So I don't remember exactly what the number is, but it's something like if you sell $1 of the S&P, you are selling like 28 cents of like the top 5 companies or something like that. That number I just said is not exactly right, but it's very close to the realm of what it actually is. So if we're coming into this period of potential August outflows, and we're coming into this period of the presidential election uncertainty, I don't want to be as bullish as I've been all year. Between basically starting today, or I guess really since starting yesterday when the market actually broke, I don't want to be as bullish right now as I have been for pretty much this entire calendar year. I think everyone knows that I have basically been a roaring bull since October of 2023, the very end of October 2023. We nailed that one perfectly, with the exception of coming into mid-February into March. I just felt positioning was getting a little bit too frothy, and we were due for a little bit of a pullback. Guess what? We got a 5% pullback in the S&P that created a bigger picture higher low that we then rallied higher. But outside of this little period right here, this little 2-month period or so, I've pretty much been nothing but a roaring bull for this entire calendar year. And if anything, the degree of my frustrations with this calendar year have just been that the rally hasn't been broad enough, that it's just been these 3-5 companies that have been rallying, and it hasn't been everything else. So Dave, to answer your question, it's a long answer. It starts with this big picture thesis for me for the market, where I don't want to be as long as I've been all year anymore. Really starting with the end of this week. I've been selling some naked puts for some extra cash flow these last handful of weeks. It's actually been working great. I'm probably not going to do that after the ones that I have on right now expire, hopefully worthlessly, but maybe not for some of them. After these ones expire, I'm probably not going to actually repeat that, again next week or for the foreseeable future. And if anything else, for long positions I do have on, I might go back to selling more covered calls on them depending on where they are. But then we get into a whole nother question that stems away from the point of your question about if the IWM and rotation can hold in, even if the NASDAQ and the S&P sell because of the market cap weights, because of the Mag 7 actually selling. So anyway, Dave, to start with your question, I want to be short, but I didn't really want to be short yet, to be totally honest. It's kind of this bigger picture thesis that I'm building into. And if anything, right now, I am overall still a bull. I'm just a bull looking for different winners than we've seen throughout the year. But the market broke, and the technicals are starting to tell me, hey, you've got this thesis, but actually now might be the time to start to put it on. Even if the S&P, which is kind of what I think is going to happen, holds in, the S&P I think will hold in because of a rotation trade. I don't think that the S&P is going to hold in because the NASDAQ is making new year highs in July or August. I have to put an asterisk on that. If there is stellar reports out of Apple and Nvidia, the earnings report can change everything, and you get this NASDAQ to all-time highs like that. But I think barring absolutely unbelievable stellar reports, because again, my thesis for these earnings names is that good is not going to be good enough for this earnings season. I think that these Qs have topped out. So if I want to not be as bullish as I have been, and I want to start to build in some short exposure that also acts for me as a hedge for my longs, I want to do that with the NASDAQ right now. So yesterday the trigger actually began, and we closed at $10 of extension. I'm not going to short at $10 worth of extension, but I was thinking about it overnight, and even Blaine in the VTF was making a comment yesterday afternoon about shorting a gap up this morning that I was also thinking about, that got in my head a little bit because I kind of agree with the thought process. I'm thinking to myself, all right, what if I get a head start on not being as long as I have been? I'm already short the IWM, but the IWM short's a different trade. The IWM short is just an extension hedge because of the $10 of extension that we got in the IWM, looking for the correction to 218, in which case I'll take that off. For the Qs, and I'm still not expecting like a bear market. I want to make that clear also. It wouldn't be impossible for the Qs to pull back 20%. But it's not what I'm expecting. I'm expecting a July through mid-September, maybe even through election, correction in the S&P of, let's just, and I'm making these numbers up. I don't like to make these really, really big, broad calls, 7 to 13%, something like that. So, 10% is officially a market correction. That's kind of where my head is, but that correction I think gets led by Mag 7. So again, I'm just trying to answer your question, but there's just so much information that actually went into it, starting from a big picture thesis down to the smaller time frame of the execution. I already want to be less long. I already want to be more hedged. I think that the weakness comes in potentially even starting next week, more likely August. We talked in the morning meeting today about how the market structure works right now, where we have this historic positive gamma. It's 12.5 billion. 2/3 of it rolls off after this week. But if there is no immediate correction next week in the market, the vol selling comes right back in, which adds back to the gamma. So you need, I think, a combination of natural August outflows with low gamma. You're not going to get the bigger outflows, I don't think, in the second half of July, though it could happen. Again, it's just so much information to unpack. That is where my head is at. So now when I'm like, all right, I'm getting the gap up this morning in the Qs. The Qs have broken. You can type up all of these tech stocks, the Mag 7 stocks, they're all kind of broken. I think that the market still stays a little bit insulated, but why not just start to build into that short now? Why not just take it now? And I can do that in a number of ways. I can do like a really small feeler where I look to add. I can implement the strategy, and this is really what I'm going to do. I can implement the strategy of just kind of working those increments and seeing if I'm right or wrong, and I can afford to give that a lot of room if the increments aren't too tight, which they're not. Just kind of doing it like 25-cent increments today, as opposed to in the past with the TQQQ, I've done 10-cent increments a lot. Where I'll let this position build against me, but I also, into this gap up here, want some now. So part of it with today's execution, and again, there's just so much going on that it's hard sometimes to get all the words out. Yesterday was only a day one, right? So I have a day one breakdown yesterday, followed by a gap up this morning. I was $10 extended yesterday, but the gap up this morning is only making me $5 extended. I want to be less long. I have this thesis that I built out. Let me short some to see if I can get day two. That was really then the more execution portion of the thesis. So now we've got the big picture thesis on why I want to start being less long, why I want to have more shorts on in my books, especially if I'm going to keep the longs on, which are bigger picture, which I'm going to. I'm going to keep most of these longs on because I've been in them for a while. I'm up a lot of money in most of them, and I am going to look to endure a potential correction in some of these longs. But what will enable me to endure that is if I'm just broadly less long, by either having smaller size in those positions that I'm keeping, or by having just more other shorts on, particularly if they can be index level shorts. So yesterday was a day one. Today we gap up, but we don't gap up back past any major levels. We just gap up a percentage of yesterday's selling. I was I'm going to short the Qs. I'm going to short the Qs in the gap up and then see what happens. I started with a feeler pre-market, and then after the market opened, I added to that feeler as just you know, a continuation of that trade. You know, so here it was. I started even way too early. I'm like, all right, little feeler, 100 shares, literally all it was. Short 100 shares to triple Q. Oh, it's going up. Short a little bit more. Short another 100 shares. Now I got 200 shares. 200 shares for me is like very small. There's nothing happening here with 200 shares. I just want it on the books to start thinking about it. It's all right, you know, it's getting a little interesting. It's moving higher here. We're getting higher prices. You know, we're working towards a retracement of yesterday. I'm going to get a little bit heavier, and then, you know, let me just kind of begin to work the position. By this point right here, 74.75, I covered all of my extra stock, and then at that point I kept a core position. Or I'm like, all right, the core position is going to be a position that I want to broadly maintain potentially for months right now, unless we become extremely extended to the downside, in which case I'll exit the position fully, and then I'll look to reshort or bounce back. That's what I did. By this point in here, all my extra stock has been fully covered. I'm keeping a smaller core position, and I want to maintain that short core position on my books. I think probably, unless we go up too much because of a stellar earnings report out of the Mag 7, I think I want to keep a QQQ short on my books basically from now through November. Unless either we go up too much because the market's proven that my idea is wrong because these earnings reports are stellar, or because we just go down so far so fast that the extension of the downside says I should cover it, and then I'll look to reshort when we're no longer that extended. So that's how I was trading it. Now I just have the core position. And then we hit a point here where we then extended to the downside on the 5 minute. This goes back to the way that I was trading yesterday when I was buying the Qs long for those day trades. I explained that in yesterday's afternoon meeting. If you missed yesterday's afternoon meeting, you can go back to very specifically how I was trading and how I was executing versus the ADMA on small time frame extension for these stocks. So right here at what time is this? This is 10:35 on the third 5 minute bar down for the Qs. As the Qs are extending down, 10:35. I want to see where at 10:35 we are in terms of extension on the daily chart. I'm almost testing myself here. 481 is where we're trading at that point in time. The ADMA was probably a little bit higher at that point, but the ADMA was probably, you know, 489.50. So we weren't at $10 of extension, which probably means that I actually shouldn't have fully liquidated my short yet based on the game plan I just explained it to you, because I just said to you that I only really want to liquidate my TQQQ short position going forward over the course of the next several months. If we hit extreme downside extension, the definition of extreme downside extension to me is going to be $10 plus of extension away from the ADMA on the daily chart. All the same, at almost $10 of extension, 9 and change it looks like on the daily chart, I liquidated my short. I said, I'm going to liquidate my short, I'm going to flip long. I'm going to flip long for a day trade here for the same reasons that I was buying it yesterday, because I think I could make some money. And again, this goes back to what I was saying earlier about credit to me. I am trading the indexes, I feel like, better than I ever have, ever. Got out of the big picture short, immediately got into a small picture long. Small picture long, same strategy as yesterday. I'm not going to get into it. Started maybe a little bit too early, built in on the way down, selling on the way up. Liquidated the position here. Yes. No. I think I liquidated the position here, actually, on this execution. On the long. And then at this execution, at 74, I got short again. I took back my core short position here, and then I went back to trading it, meaning taking more than the core position, similar to what I did here, right? In the beginning of the day pre-market, I started with a core position, I added to my core position, and I added as a trade. I got out of my trade, at 10:30. I got out of my core position at 10:35. I flipped long at pretty much the same time at 10:35, 10:40. I got out of my long day trade position at 10:50. I re-entered the core position at 10:50, another 25 cents higher. I re-entered a trade to the short side as it bounced further into equilibrium. I liquidated the trade on the short side, not the core position. I still have the short core position here at 11:05. And then I exited again the core short at 11:30 and bought back then a day trade to the long side at 11:30. Liquidated the core position again at 11:30. Why? Because of the daily chart extension and because I wanted to enter a day trade to the long side because of the small time frame extension at 11:30. We're very extended on this 15-minute chart. We're even extended on the 5-minute chart at 11:30. Exiting my short position. Where are we on the daily chart at 11:30 on extension? That's what I want to know. At 11:30, the QQQ is at 477. The QQQ daily ADMA is at 489. This is what I want to do. The first time I did it, honestly, it was a little bit shallow. This is what I want to do. I have $12 of downside extension in the Qs at 11:30. I'm liquidating my core position, and completely separately, because of what the 5-minute looks like, I decided to flip long for a quick scalping type of trade. Same trade. I just want to make a few bucks, bounce back up to the ADMA. I do it. I was thinking about looking for a little bit more, but I wanted to get lunch. So I was like, all right, at the ADMA, I'm out, and I'm not now here reshorting my core position because the daily extension has become too big. The daily extension now is $12 worth of extension. If anything, when I was grabbing lunch, the one thing I was considering was, should I really be looking for more based on the daily chart being $12 of extended to the downside now? I said, you know what? Big picture thesis, that's not what I want right now. I don't want to be adding a boatload of additional long exposure right now, especially in the Qs. If I add any more long exposure, I want it to be RSP, IWM related, not QQQ related, not Mag 7 related right now. So I did not reinitiate my short position in the Qs at any point, that core short position, at any point during the day today because of just how extremely extended we are. You know, we're actually trading $1.50 higher here after hours from the market close, which is surprising to see based on Netflix. Netflix is all the way back. It's not that surprising to see. That's great because I want the core short position in the Qs. I want the core short position in the Qs. I'm fine with it going against me. I'll build into it if it goes against me. I more or less want to, like I'm saying, this is my thought process right now. By the way, my thought process is subject to change. My thought process right now is I want to have more exposure to the short side, particularly in the Qs, from now basically through the election. While maintaining those longs that acts as a hedge. I can make cash flow from it. It'll cushion the downside if we get a broader correction in August, which I'm hoping that's more of a rotational correction than a sell everything correction, but that's certainly to be determined, and it's a ways out now. Tomorrow morning, if we're gapping up, we'll see where we gap up to, but it's very likely tomorrow morning that you'll see me reinitiate the core QQQ position and then potentially initiate trades on top of that. So that was a very long answer to your question, Dave. I appreciate you asking the question. But you know, I'm happy to answer it, even going really in depth there. And like I said, there's just so much going on from a big picture down to the small picture on how I'm trading with the core position versus the day trades, the longs, and then exiting the longs, coming in on the shorts. And you know, credit to me, I couldn't have traded it better. I'm like 100% win rate right now. I shouldn't even say this because I'm cursing myself by saying this. I'm 100% win rate on like counter trend longs on an index level for these last few days, and at the same time, 100% win rate on the with trend trades, kind of with them also at the same time. I've been trading really well recently. It is what it is. Maybe I just screwed myself and I get too big headed and mess it all up tomorrow. Hopefully not. I won't if I stick to the game plans. If I stick to the game plans, like I said, I'm getting nervous about my psychology. This happens. Bill knows. Profit drunk. When you can get profit drunk and then start being bad. Yeah, it's bad luck to be superstitious. So I'm worried about how well I've actually been trading. That especially when I talk about it like this, that I'm setting myself up to start trading poorly. But what do I always preach? I'm saying this out loud to put it in my own head. What I always preach when anybody basically has any questions about bad trading psychology, the key to countering bad trading psychology is good game planning. I've got good game plans right now, I think. And by the way, you can have a good game plan and still have the trade fail. That's okay, right? Because part of having a good game plan also has the risk management portion of it built into it. I just need to make sure I follow the game plan, and it doesn't matter what the psychology looks like at that point. So that's how I'm trading the indexes, Dave. Appreciate the question. I hope it helps. All right, a whole bunch of other questions came in. I see some stuff in YouTube. I see some stuff in the VTF. I'm going to stick with the VTF first here. From John Bulger. When you said that you bought some, is that one lot of shares, that 100 shares or 1,000 shares, like a default in DOS trading software, or a certain percentage of your account value? Just trying to gauge that in an event I would follow you on an intraday trade like the TQQQ or the TNA. It is not a percentage of my account value. It is it's basically one execution. So what one execution, I don't want to say one lot because it's not necessarily going to be 100 shares when I do this. Sometimes it is 1,000 shares, sometimes it is 100 shares. But when I'm taking that approach, usually whatever the amount is that I'm buying or selling is the amount that I stick with. So if it's going to be 100 shares and I'm doing it every 25 cents, then almost always, sometimes there's some exceptions, but almost always if I'm doing it with 100 shares, it's going to be 100 shares. Every buy, every sell will be that same amount. Or if it's 200 shares, every buy, every sell will be that same amount. So I hope that answers the question. You need to just make sure that you understand if you're implementing this approach, if you want to join me on it, you need to make sure that you understand what the risk is. Because I'm not trading these things with stop losses. And this goes back to something that I've said in the past, and it's something that I've always struggled with as kind of a mentor, teacher, whatever you want to call it, is talking about the difference between doing what I actually do and talking about the way that I trade. Right now, when I just went over the cues, I talked about how I traded it. That does not mean that should be how someone else traded it or trades it. Because I don't know your account size. Actually, I do know most of your guys' account sizes, but broadly speaking, I don't know your account size. I don't know, what risk is appropriate to you. I don't know what your bank account looks like. I don't know what your personal situation looks like. So, one thing that I've always struggled with is teaching the way that I think that someone can trade regardless of whether or not you have a $5,000 or a $500,000 account versus the way that I actually trade. I have a six-figure account basically that I work with. That's the range that I'm in. It's not a seven-figure account. It's not a five-figure account. It's a six-figure account that I work with at this point in time, and I know what's appropriate for me based on that account, and it might not be appropriate for everyone. I was down 5 figures in the IWM at a certain point when I started shorting this. Are you comfortable, if you're following me in that IWM short and mimicking my executions, are you comfortable being down if you're trading it exactly the same way that I am? And I was only doing 100 shares with the IWM at a time. Are you comfortable being down? I was down probably $13,000 or $14,000 at a certain point in the trade. I finished positive in it. I made money in it. I made decent money in it. I just want to make sure like that everyone knows how I'm trading, but doesn't necessarily mean that they should follow unless it's appropriate for you or you want to be involved in it. Know your own account, know your own risk. For me, I didn't bat an eye when I was down $14,000 in the IWM, especially because I had all these longs on, so my P&L on the day was still positive. Whereas for someone else, maybe you have no other positions on, you've got $20,000 in your account, you're following me in the IWM trade, you're down $14,000 in it, and you're freaking out because you're very close to, if this trade getting any worse, your entire account blowing up. So just please, 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 I've been trying more recently to talk a little bit more about the very specifically what I'm doing, what I'm trading, and how I'm trading it, and which therefore means I'm doing a little bit less of the approach of trying to teach a system where every single person can be in. But really what I want to be able to do is a balance more, I think. A balance of telling you guys exactly what I'm doing so that you can learn from exactly what I'm doing and potentially participate in exactly what I'm doing if it is appropriate for you, versus also at the same time teaching kind of a system and a methodology that could be appropriate for someone where following me into a trade is not specifically appropriate. So appreciate the question, John, and I hope that helps. Scrolling down here, next I'm seeing from Dennis. When market conditions change like they have this week and it favor some of your better setups, do you change size and trade more aggressively? Yes. Especially on the trade more aggressively part, but both. If so, how much and how do you expand? So definitely trading more and more trades in a market condition that I like better. So that automatically inherently means that you're taking more overall risk because you're just taking more trades. The trades, like the day trades that I've been doing at the index level that have been making me money recently, were not trades that you could do in June when the indexers are just super flatlined, which is by the way I'm loving this market environment right now. So it's a better market environment. There's more opportunity. Therefore, I'm trading more and I'm trading bigger on it. And that goes back to what I think is a major theme for trading success, which is knowing when there's more opportunity and being more aggressive, and knowing when there's less opportunity and being more passive. I really think that's a big theme for trading success. Part of your question is, by how much am I expanding? I would love to tell you that I've got a perfect system on how much risk I expand based on how much I view the market conditions as improving, because I think that the ideal trader, and I am not the ideal trader, has a rule and a system in place for every single thing that they do in regards to the market at all times. I do have a rule in place for the vast majority of things that I do with the market at all times. I don't have a specific rule that answers your question. It's a little bit more, and I hate this answer, especially if like a new trader says that they do this. I just want to jump out the window. It's a little bit more based on feel. It's a little bit more based on feel, on how I feel the opportunities out there. So, not a great answer, Dennis, but it's an honest one. Continuing with a follow-up question, looks like you have also, if you've been trading really well for months, do you increase overall risk gradually as well? Yes. Despite, of course, different risks for different type of plays. Yes. Yes. I like the idea of, as you see trading success, slowly and incrementally increasing the overall risk. And I think that one of the best ways to do that, by the way, is to increase your account size over time. As you make money, to not take 100% out of what you make, take some out, treat yourself, but leave some in, build the account, and add more scale. With that said, a big mistake that I've seen traders do is get too big too fast when they see success. So that's why I emphasized or reemphasize it. small, gradual expansion of that scale on what you're doing, not 10xing what you've been doing overnight. Like not even close to 10xing, not even 5xing, not even 3xing, 1.2xing what you've been doing, 1.5xing what you've been doing, maybe 2xing, maybe it depends. Even that could be too big. What you've been doing as you see that success if you've been trading well for a period of time. Don't put yourself in a situation where you've been trading great for months and then you size up by so much that you have a couple bad days of trading because you can't even handle the size, and then you just threw away all the 3 months of success that you had. Okay, Dave. Sounds good. Sorry, Tate. Just seeing your comment there. Awesome. Scrolling through here from Paul. Can you ballpark the number of executions total across the board, everything you average per day? I realize it ranges a lot, but just an idea. Yeah, someone asked me the same question yesterday. Yesterday was a particular lot of amount of executions, and I guesstimated looking at it that yesterday I did like 1,400 unique executions. Today, if I'm eyeballing it, it looks like I did 600 plus. Not as many today, but a lot. If I wanted to ballpark, I don't keep this as a statistic. If I wanted to ballpark an average, it's probably 400 in a day. Sometimes I have days where maybe it's 100 or 200. But if I had to say an average, I would say 400, maybe a little bit less. So going back to Dennis's question, if normally it's 400, but this has been a really good environment, I want to see higher outliers. You know, yesterday being 1,400, today being 600 plus. That's what I want to see when the opportunity increases. From Dennis, yeah, no system here either for expanding risk in different market conditions, but going by feel. But for increasing size over time, I'd go with 10%-ish steps. To me, it sounds like potentially a lot. If more than that, if more than with mental prep and no hesitation to step back quickly if it affects me psychologically. Definitely agree with that last statement. You need to see how the increasing in size affects you. It will affect you. You can't go from swinging $1,000 a day to swinging $10,000 a day without it mentally affecting you. Just seeing the P&L. You want those numbers to increase gradually over time. If I saw how my P&L moves now 13 years ago, I probably would be sick to my stomach. But it's been a gradual, decade plus incremental increase that got me to where I'm at. Cool. Popping over to the YouTube. Braden asked me a question. How many years did it take you to have your first six-figure year? Trying to figure out if it's a question I want to answer. I don't really like talking about my P&L broadly. I'll talk about it in ranges sometimes, and your question is kind of more of a rangy question. But I don't think it's the right question. I think that the question is more about what is the process to continuing to size up over time. I can tell you that my first year as a trader, I traded very, very, very small. You know, I probably traded with like a $200 max loss and traded very small, and then that increased over time, and you know, maybe by year 3 I was trading big enough where, you know, having a six-figure year became possible. So I'll kind of answer it that way. So yeah, you know, like into year 3-ish. I also agree with what Dennis just said. Sometimes you got to be a little bit uncomfortable. Yeah, that's how you grow. You don't want to be overly stuck in a comfort zone. You want to expand over time. I'm not the biggest trader at T3. There's traders that are way bigger than I am. I think I trade pretty big, but there are traders that I know who are way bigger than I am. And I just look at it as goals. I know guys that make and lose 7 figures a day, which I don't make and lose 6 figures a day. I typically make and lose 5 figures a day, but I know guys that make and lose 7 figures a day. We got guys at T3 who do that. So I'm not there, but it's not about that. It's about process. From Uvixi Bull, I've been trading the Dow futures on a 15-minute time frame. I shorted after 10:30 candle finished and didn't cover until the first green bar at 12:30. Nice candle, nice bearish engulfing 15-minute candle off a large degree of extension on the 15-minute chart with a large degree of extension, I'm pretty sure, on the daily. Love it. And I didn't cover until the first green candle at 12:30. It's a good hold. Would you take this, or is the signal bar too wide compared to the opening drive? No, I would take that. I like it. You need to... I don't like this in a vacuum on just the 15-minute chart. You need to be combining that with your understanding of how extended we are on the daily and where the daily is. Yes, Benjamin, in light of your own financial condition, per the disclosure. Cool. All right. It looks like I got through everything. Appreciate all the questions. Appreciate all the commentary. I really do think that it's the questions and commentary that make the afternoon meetings really good. Not just me rambling about stuff. So appreciate the feedback. Keep it coming. Appreciate the questions. Keep it coming. It's been an awesome week at this point. I hope you guys are doing well, and really hope that you guys are learning as much or more than anything. And we'll see what Friday brings. So have a great night. See you all then. Thanks, Robert. Thanks, Cyril.